schedules. I think now we are a bit relaxed. However, in the month of December, we do have our GST season coming up for most of the practitioners. So to handle this thing, Bangalore branch has thought would have practical issues and resolutions in filing GSTR-9. So considering the hectic season which is coming up, so today for this session, we have CA Akshay Hiregange to handle this session, who has qualified as CA course in 2016. DISA qualified in July 2021. He is a partner of Audit and Assistance Wing at Hiregange and Associates LLP. He has experience over 3 years in internal audits, compliance, and indirect taxes. And in the past 6 years of directing focus towards GST, including audit and consultancy matters. He's headed the impact assessments of various industries such as automobile, software, manufacture, logistics, real estate, construction, education, job work, charitable trust, etc. He's also undertaken GST training for corporate clients, and he's been invited by various professional communities as a speaker on GST on multiple occasions. He's co-authored Due Diligence and Direct Tax Booklet, a regular contributor to GST articles, and replies to KSCA, CA Club India, and Tax Guru. With this brief introduction, I would like to welcome CA Akshay Hiregange.
Thank you, Pramod.
Yeah, and without keeping much of you guys waiting on this, I think we can start. We can go ahead. I would like to present to you before Mr. CA Akshay Hiregange. Over to you.
Yeah, thank you. Thank you for the warm introduction. I would also like to firstly acknowledge ICA for giving this opportunity. And as Pramod mentioned, due to the hectic schedule which was there in the past for practitioners, it was very difficult to focus on GST. And due to the recent changes also which have happened, where they have actually forced extension in the updates for 21-22, they have now pushed it to 20th November practically. Of course, I mentioned 30th November, but you have to file the returns by 20th. So having said this, there is the next requirement coming to our GSTR-9 9C is going to be in a very short period of time, that is 31st December. So keeping that in mind, the amount of work that may have to go into this activity is significant. And having the GSTR 2B reconciliation is also an added burden. So we will be discussing on the forms. There will be some important reconciliations that we'll be speaking about, the do's and don'ts of filing this GSTR 9. There is some linkage to 9C, so I will have some information on that, but I understand there is another session also on 9C which is being planned. There is in this PPT a clause-wise analysis. I will try and go through all the clause-wise analysis to the extent possible, but for the benefit of everyone who have registered, this PPT in a PDF format will be shared for your perusal later on. So the main crux of our session being the advanced issues and solutions also will be discussed at length. If any of you have any specific issues and questions in relation to GSTR-9, please wait till we have reached the advanced issues and solutions. Majority of your points may be resolved by then. If not, we can then take it up through the chat box. I will be giving some time for these issues and solutions also. So getting into the anatomy of GSTR-9, the GSTR-9 in the initial stages was supposed to be a simple return, which was supposed to be a consolidation of your GST filed returns only. They had no linkage to your books of accounts, what you have considered there. And it was only a consolidated statement, which would have actually made our lives easier. But because in GSTR-3B, the possibility, and GSTR-1 also, the possibility of revision of returns is not there, they then gave this option of considering the values as per the books of accounts in GSTR-9. But having said this, they have not given this completely. It is only for the outward supplies. That means if the government's revenue is increasing, then they're telling, okay, please update those details. But if you have missed some ITC, then they're saying, no, sorry, we will not give you the ITC. So yes, this is not very conducive, but the law has been framed in such a manner that they have put in the timelines and the law is in that manner. So extension, when we come to, the due date, as you all know, for financial year 21-22 is 31st December. Extension this time around may not be expected on two counts. In the past, of course, so for 17-18, the due date was extended due to the introduction of the law. 18-19, 19-20 onwards, the main extension was due to the COVID and also the extensions in income tax. Now we see that there is no issues in relation to COVID, nor are there any major extensions in income tax. So keeping that in mind, I feel that the 31st December due date will not be extended, which means as professionals, we need to reach out to clients immediately, ask them to give the data which is required, and follow up as soon as possible. Keep our schedules, our priority in line, so that we do not have any regrets from any clients or any bad mouth which is happening for us, because we of course cannot market ourselves. So word of mouth becomes very important for our services. So keeping that in mind, please have this due date as a very clear deadline for us. Probably many people will not be celebrating their New Year's also this year. So part 1 of your GSTR-9 is your basic information, which is majoritively auto-populated. Part 2 is your outward supply data, which will have majority of your corrections, if you have any, which may be coming into this table 4. Table 5 is in relation to the outward supplies, which are not liable to tax, which are just the disclosure in nature. Part 3 is another important table where you have your ITC data, which has to be auto-populated, ideally as per your GSTR-3B. There are some specific bifurcations which the government is requesting. We will come to that in the clause-wise analysis. Part 4 is your details of tax paid. This table again is a very important table wherein you need to be clear as to what is the payable against the paid and have a clear identification of reasons for variances. Part 5, which comes, is your transactions of previous year, which are disclosed in the current financial year, which means 21-22 transactions disclosed in the 22-23 up to November. Please note the form has not been updated, which means it will still show April to September, but that has to be read as April to November, considering the extensions of timelines as per the recent notification 18/2022. The other informations in the table 15 to 19, most of them are optional to be filled, other than a recent change, which is your HSN outward summaries. So again, there you would see an additional burden of data consolidation and verification from the CA perspective. So coming to the taxpayers who are not required to file the annual returns and the GSTR-9C, which is your reconciliation statement. So in this regard, below 2 crores, if the turnover is below 2 crores, then GSTR-9 need not be filed. And if it is below 5 crores, then 9C is optional. So between that range, GSTR-9 is mandatory. Above the 5 crore, of course, all GSTR-9s need to be filed. So for financial year 2020-21, GSTR-9C was amended to remove and omit the Part B certification criteria, wherein chart accountants and cost accountants were not required to certify it anymore. Of course, the reasons based on which they removed these certifications were very flimsy. They said that the liability that the taxpayers have paid through GSTR-9C is not sufficient, and therefore they were doubting the work which was done by the professionals. But to be fair, most of the professionals ensured that the taxpayers had discharged their liability well in advance, either through DRC 03 and through their GSTR-9, and therefore ensuring that the 9C was a clean report. So of course, this was overlooked by the government, and therefore this additional incentive which was there for us chartered accountants, and to ensure that we are there as a check mechanism for the taxpayers, this has now been removed. Keeping that in mind, of course, I have some information in relation to the management report, which is something that we still will be able to do upon in giving the bird's eye view in relation to all the reconciliations, giving clear reasons for variances to the client in a single document. So as of now, most of the variances, the documentation will be spread across various Excel sheets in various folders. We will now, through the GSTR-9, be able to consolidate this and give the management a single document with a clear information for the reasons. This will of course help them during their departmental visits, the audits which will happen in the future after 3-4 years. Probably this will be much more useful whenever there's a turnover in the accounts team at the client end. So the other area which we also can assist is in identifying any additional liabilities, giving them the summary details, and ensuring the documentation of the payment. Along this process, as chartered accountants, we would be able to identify certain internal accounting process lapses at the client end, and we would also be able to suggest them some better practices which can be done. So although the certification has been removed, in my view, the CA's work has not been diluted. So to that extent, if we are able to do this, we would be able to give our services to the client in a much better fashion. And therefore, this will of course help in retention and also getting more clients in the future. So although the MRL and the other processes which are given as per your standards of auditing and SAS practices, those are not mandatory. I feel as chartered accountants, as per our best practices, this is something that we can consider. So coming to our GSTR-9 important reconciliations. So we have turnover reconciliation, which is in relation to table 5A of your GSTR-9C against your audited financial statements. This becomes particularly difficult when there are multiple GSTINs, and therefore this is something we should ideally ask from the client to share with us in advance. If that is not possible, then of course we'll have to get into their books of accounts and prepare this ourselves. The requirement is that we are able to match it to the value as per the audited financial statements, which will be shown in table 5A. That should not be an edited figure. That should match to the balance sheet and the P&L values which you are disclosing as a additional documentation while filing 9C. So please ensure it's the same value, or else again this may attract the departmental questions and interrogations. Next is your table 5N versus table 17. Table 17, as you know, is your HSN, which is in relation to outward supplies, which is now mandated for financial year 21-22. Verifying the total value as a check mechanism against the values mentioned in table 5N, which is a total of your table 4 and table 5, will be a very useful check mechanism. Outward taxes, liability as per books and liability as per GSTR-3B must be compared. Ideally, if you have invoice level reconciliation, this will be very useful, wherein you can also prepare a rate-wise bifurcation as per books, which will further be used for your GSTR-9C table 9 disclosures. So please note, in this entire session, I will be referring to many tables, many forms. So that's why if you are not clear, please keep the form by your side, if either in a book format or in the PDF format. Please have a look whenever you are listening to this, if you are not very clear about what is in the forms which are given. So in the CGST rules part B, you will be able to download this also from the CBIC website. So outward taxes, rate-wise liability as per workings and rate-wise liability as per books. So this is something which is a difference from the earlier point. What I mean to say here is, while filing the returns on a monthly basis, they'll be using certain workings. Sometimes the books may undergo certain changes, but the workings does not. So to this extent, I am giving this additional reconciliation activity, which will also help in matching what was considered in 3B and your books. This also gives an indication on the internal controls of the entity. If the books values have undergone changes, that means that they may be having backdated entries and there may be some internal control lapses in the software. GSTR-1 versus 3B, of course, this is automatically available in the portal and various tools that are there. This will help you verify whether the values are the same. In the recent past, they have ensured that GSTR-1 must match with GSTR-3B to ensure that no liability that is disclosed in GSTR-1 is missed to have been paid to the government. So keeping that in mind, this check now has some more significance. Inward taxes, credit as per books versus credit as per GSTR-3B. This is very simple to read, but it's a very difficult exercise because of the fact that we are not claiming the credit as per books in GSTR-3B. There are a lot of reconciliations that we are doing. There are a lot of ineligible credits which may be considered in the books, which we are not considering in the 3B. Many credits are not accounted as such and may be considered as an expense in the books of accounts, and therefore there will be a mismatch. And the other area which arises is the seventh point, which is in relation to closing balances. So in relation to credit, keeping in mind the concept of opening balance and the credit which is utilized to pay the taxes, these entries must also be passed in the books of accounts as when we are filing the GSTR 3B. If you are using the credit for other payments, say DRC03 pre-deposit, in those cases also those entries must be made in books of accounts so that you can match while you're performing this closing balance reconciliation. This reconciliation is also very useful when you are filing your GSTR-9C. You have your table 12 and 13, where you do your ITC reconciliation. Next is your spillover transactions in relation to previous year financial year, which also will lead to your present financial year spillover transactions. So what I mean to say by this is 2021, the transactions which have taken place, some of the transactions of the year may have been disclosed in the next year, or which were previously disclosed are now accounted in the next financial year. So any number of spillover transactions may arise. There's also goods in transit type of transactions, amendments, which may be done. So keeping all this in mind, a tracker has to be maintained as a spillover transactions tracker, which will then enable you to first fill the form GSTR-9 correctly and also verify what is being disclosed for the next financial year. What this means is that I also need to verify the previous financial year 2021 GSTR-9, and those spillover transactions should also be verified to ensure that my reconciliation for this period is clear. So if it is already matching, but there were spillover transactions, that means there was some kind of error which was done either in the past year or this year. Next thing is, of course, the identification and rectification of any modifications that you need to do for financial year 21-22. Although, yes, we are beyond the GSTR-1 due date, which was yesterday. If there is anything in relation to ITC, you still have time for this. You can verify with your vendors where if they have not filed, then there are other business practices that may need to be considered, which is you may need to withhold the taxes, whether there's an option of credit note and a fresh invoice. These are things that may need to be considered, and who will bear the burden of the tax. So keeping all this in mind, wherever you have your variances, please have those reasons listed carefully. And as chartered accountants, we need to verify whether those reasons are sound and correct. Coming to the do's of filing your GSTR-9, 9C also. So of course, filing all your returns within the due dates will help you avoid any interests, late fees, notices from department. And in your 9C workings, avoid keying in any values. Have all links available in the same sheet, and have 9 and 9C also in a single worksheet. So this will ensure that all your linking is being done to those 9 and 9C tables, and do not link 9 to 9C directly. It should be linked only from the workings that are being prepared. And those workings, of course, should have a clear basis of from where the data has been claimed. So generally, what is the practice is that the articles and the paid may not have this level of understanding. They sometimes verify the same details. They'll do GSTR-1 versus 3B, and then they'll do GSTR-3B versus 3B itself, which then basically, as a chartered accountant, we may think, oh, this is matching. And if we are not looking into depth, that's where we may get into trouble. So of course, filling accurate data, I do not need to say. Performing invoice level reconciliations. This exercise is very beneficial for all. First thing, as chartered accountants, we will be able to substantiate any of our findings. And for the taxpayer, he will be able to identify which vendor, which customer there are any errors, and take the respective action which he needs to take from a business point of view. So this is very important. And later on, of course, it helps you provide information to the department without any assets. Maintaining an ITC register with capital goods bifurcation so that it will help in preparing your table 6 of GSTR-9. So when I say ITC register, I mean a very robust internal document which is having all the mandatory details which they mention in the proviso to Rule 36 subclause 2, where they give all the details of GSTIN, your the taxable value taxes, but they do not give the requirement of bifurcating your nature of your supplies, which is into goods, capital goods, input services, nor do they have a bifurcation of what it is used for, which is whether it is used for taxable supply, exempt supply, or is it a common service or common goods. In relation to all of this, this helps in many ways in filing your GST returns. And the major issue which is there here is it will help you do your 2B reconciliation in a very good manner. So keeping a robust ITC register is the need of the hour, which will then help in maintaining a lot of other information very clearly. So in relation to this, there are many articles also which have been written in CA Club India and Tax Guru. You can have a look in your free time. Next is maintaining the details of ITCs which are claimed, reversed, reclaimed, and wherever the taxpayer is fulfilling the conditions under section 16 also can be verified. So here is where the claim, reversed, and reclaimed concept is also linked to a concept of under protest. So as most of the chartered accountants know that under protest concept was there in the pre-GST regime, but in GST it has not been included in the GST law. But as per most of the known persons in our industry, well-known, well-read, and advocates also, some of them, they back up the claim that ITC can be claimed, reversed, and reclaimed when it is under protest because it is in the lines of natural justice. So if I am not clear on my credit, it doesn't mean that I cannot claim it. I should have the opportunity to be able to claim it once I have the clarity. So how do we do that is through this under protest option. Of course, this can be discussed separately, where many people due to the Safari retreats case also have taken this benefit. In case of your amendments outward register, maintain all your original values so that you can verify the variances between the original values and the amendments and verify on a sample basis against the actual documentation. Performing your reconciliation on monthly or a quarterly basis between books and returns will avoid a pressure at the year end. Rule 42 and 43 ITC reversals have to be done as per the rules. Of course, the format for Rule 43 is much more cumbersome compared to Rule 42, but that is the law and we may have to follow it. Rule 42 also has an annual recomputation requirement, which also has to be done, where presently it can be done up to your November month also. Invoice level 2B reconciliation can be done from January 2022 onwards up to December 21. Only Rule 36(4) was valid, which also can be questioned on the grounds that there was no authorizing act in the GST law. Maintaining your advances and advance adjustments will help in preparing your table 5 of GSTR-9C. So what are the things that we need not do or should not do while filing 9Cs? Don't forget to file nil returns, because if you have not filed returns, the pre-requirement is to file all the returns and therefore you cannot file your 99C. Another thing is you will be burdened with late fees for no reason when there is no liability to be paid. Do not link 9C tables to GSTR-9. There are certain values which you need to consider from 9 in the 9C tables. Those please key it in as per the download which will be provided from the portal once you have filed the GSTR-9. Otherwise, do not get into linking 9C because sometimes the errors in filing are due to these reasons. These returns also, like the GSTR-1 and 3B, cannot be revised, and therefore verify without fail. Have a make a checkup policy if you can within your teams to ensure that the data is accurate. So a simple summary which I have made in that cloud is outward must match with your books, inward must match with your 3B. Any additional short liability can be disclosed in GSTR-9, and you can also, if there is a short liability, can be disclosed in 9 and you can apply for a refund separately. additional credit cannot be claimed in GSTR-9. So this is like a simple summary of how we can take a thumb rule to follow and file the GSTR-9 in the by 31st December. So I will just take some questions. I see some things in the chat. Do we need to file, need to give HSN details for B2C transactions if annual turnover is below 5 crores? So here the requirement is to file the HSN in digits format. So if it is below 5 crore, you need to give 4 digits. And therefore, yes, you would have to give the HSN details for all transactions. Do we need to show transactions of 2021 disclosed in 3B of 2021, 2021-22 in GSTR-9? So transactions, if you mean that they are booked in 2021 and disclosed in 3B of 21-22, that we will come to, we'll be discussing specifically part 5 transactions. So we will discuss this transaction over there. So Aman has asked, will you share PDF version? Yes, I think that can be shared by ICI team. I think Pramod or Suraj can confirm that. Whether reversal of October can be done in October 3B as date of ITC claim has been extended to 30th November. So what I understand is you're asking October related credits, can you reverse in the October month? So I'm not able to understand your question here. You can reverse the credit of the month in the month. If it's the previous month's credit also you can consider. If you are asking in relation to 21-22 credit and you have to reverse it, please consider it in the October GSTR 3B, which is due by 20th. You have the ability, of course, to file it up to 30th, beyond which if you consider, say you filed it on 5th of December, they may not consider the adjustments in relation to 21-22. Additionally, you will also have to pay late fees and interest for the delay from 20th. The due date has not changed. Yeah, so we can get into the clause-wise analysis. First and foremost, let us see the relaxations. I would like to apologize for my frequent clearing of the throat. I am just recovering from a cough and cold, so please bear with me. Relaxations in relation to the GSTR-9 filing. There have been many relaxations from the start, which have been very useful. But for financial year 21-22, all the bold items are now mandatory. So please keep that in mind. Amendments, credit notes, debit notes, details. Earlier, you could show net off as a figure in table 4 and 5. But for table 4, which is your taxable outward supplies with taxes, there it has to be separately disclosed in table 4I to 4L. Earlier, all the exempt nil rated non-GST supply could be consolidated in exempted column, but now they are asking you to disclose the non-GST supply separately, which means exempt nil rated can still be consolidated in the exempted column. Non-GST must be considered separately. The reason for this is there may be certain non-GST supplies wherein you may be putting the schedule 3 entries also. What I mean by schedule 3 is your items, say on sale of land, building, any transactions wherein it is happening entirely outside India, but the taxpayer is in India. So these kind of transactions may be disclosed in non-GST supply, because in the requirement, they have said that non-GST supply should also include no supply transactions. So to this extent, the department may not be able to correctly verify whether what is your turnover against the ITC against which you have claimed, whether you should include the non-GST supply also. So this is a requirement wherein they are trying to bifurcate it and show it separately, and then they may take it into consideration. Of course, all those supplies also which are not liable to GST, which are mentioned in your section 9 of the Act, just petrol, diesel, liquor, etc., will have to be disclosed under this non-GST separately going forward. ITC bifurcation from 1920 itself, they had the inputs and capital goods bifurcation where the input services could be clubbed with inputs. That remains the same. ITC from your RCM registered and unregistered persons can be clubbed into the registered persons table in 6D. All ITC reversals can be considered in a consolidated manner in table 7H, although your transitional credit reversals have to be considered separately. Probably for 21-22, I do not see any such transitional credit, which ideally would have arisen based on departmental audits where they were asked you to reverse certain credits. This is also very useful to know that any credit which was reversed through your DRC 03 paying the ITC, that also will have an impact on your reconciliation when you're doing your closing and opening balances of your credits. There is also an option to upload your table 8A to 8D, which is your GSTR-9 table 8A to 8D, as a signed PDF with the GSTR-9C. So this is your 2A RICO with your ITC. So this can be done to avoid one simple fact is that the government, of course, is using a lot of data analytical tools. And these tools seem to be very rudimentary, wherein notices are coming in a very haphazard manner and giving a lot of unreal and unactual data where they're asking you for demands on values which are actually not yours. So this data, the way they are capturing it and how they are doing it is not very clear. And this option of filing 8A to 8D may avoid such a scenario. But in my view, this information still has to be provided to the government. And therefore, this option to upload as a signed copy may not be very useful. Reversal and availment of ITCs in previous year may not be filled, table 12 and 13. That is your part 5 transactions. This still remains as a relaxed item. Refund your information of your inward supplies, deemed supplies, and HSN inward details remain as optional tables. HSN outward, as we have discussed, is now mandate. So in this clause-wise analysis, on the left-hand side, you will find the data as per the form itself. Therefore, you do not need to refer the form. And on the right-hand side, there are some useful information of how you can capture this data or some tips on how it can be filled also. I have also, to the extent possible, covered all the relaxations again in these slides. So we'll just go through this briefly. I will not spend too much time in relation to clauses as all the clauses are mentioned in this slide. So coming to the table 4, which is your table 4A to 4L, wherein you have your supplies which are being made B2C, B2B, 0 rated, supply on payment to SEZ on payment of tax, deemed exports and advances. So in relation to all of this, this can ideally be taken from your GSTR-1 to a large extent, and inward supplies which are liable to be paid on reverse charge basis is something that you can take from your GSTR-3B. From 4I to 4L, whatever credit notes and amendments which are there, this is something which has again can be taken from GSTR-1, and the amendments which are there can come from your table 9 of GSTR-1 also. So keeping all this in mind, one specific thing which has to be considered is the 4I and 4J. 4I, 4J is something where it says is issued in respect of transactions specified in B2E above, which means I should have shown the invoice also in the above tables in 4B to 4E. The reason they have not included 4A is because it should be shown as a net off of its credit notes and debit notes. But the data here, what happens is, say I have raised a invoice in say 2021, and I have raised a credit note in relation to that invoice in 21-22 within the time limit. Now, where would you disclose this credit note? So there are two ways of disclosing this credit note. Either we can disclose in 2021 because it is a credit note which is in respect of transactions specified in B2E above, or because it's a transaction of 21-22 because it is accounted and reported in 21-22. You do not disclose anything in 2021 and you consider the credit note only in 21-22. In my view, both these ways are appropriate, but if you are following a method, please ensure you follow it consistently throughout so that your reconciliations also can be verified clearly. Credit note, as all of you know, has the time limit, which is now they have given 30th November, but that could be construed to be 31st October, your date of credit note, so that you can disclose it in the returns of November, which are due in November. Debit note does not have a due date. Here, whatever tax is to be collected additionally has to be considered. So the next question is, should I consider my financial credit notes, which are those without taxes, in my GSTR-9? So in my view, these need not be considered in GSTR-9 financial credit notes. They can be considered as an adjustment item when you're filing your 9C, because it would have affected your turnover, which will be disclosed in table 5 of GSTR-9C. So one of the main things, if you see para 4 of your GSTR-9C instructions, you will see that they have given an option to upload the details in table 4 as per the liability what is there, which means assuming that your books of accounts are audited and vetted, the liability which is disclosed there is the final liability which is to be paid. Then, considering whatever liability has been paid through my 3B and DRC 03, if I have not paid sufficient amount of tax, I have missed certain transactions, I can consider them for the first time now in GSTR-9. So that option is there presently for table 4 and table 5. So next you have your table 5, which is those without tax. Here, even if you have missed any disclosures in the past, if you are disclosing now, I do not see a major issue. It can be disclosed now also for the first time. Another very useful disclosure here is sometimes the export and the SEZ supplies were disclosed in exempt columns in GSTR 3B. And without a revision option, this became an issue and this affected the refunds also. So while filing GSTR 9, this correction also can be done. The table 5C, please be very careful. This is not the liability which is to be paid by the supplier itself. It is to be paid by the recipient. So this is again a transaction which is not liable to tax for the supplier. All the others, exempted, nil rated, non-GST supply, which also includes no supply as we discussed, is coming in this table. Here, the credit notes, debit notes, the amendments which are done in relation to details in 5A to 5F. Here, you need not have a separate disclosure. You can net them off directly in the above tables. So this is the end of your outward tables. Next, we have the inward tables. I will take up the questions once I finish the clause wise altogether. Table 6 of your ITC is now become a very important table, and the disclosure against have to be very careful. Table 6A, as you all know, has the details which is coming from your table 4A, which you need to consider from GSTR 3B only. Please do not consider the credit as per books, because then what happens is the total value in table 7J becomes the credit that you have actually claimed, availed, but that it may not be the right values if that is the value as per books. So please consider your GSTR 3B values itself. So then the obvious question which comes is, if there is any credit in my books which I have not claimed, what do I do with it? The simple answer is pass it as an expense, because the credit may not be eligible now because of the time limits. Of course, as we speak, as on date, any missed out credits, once you have done this reconciliation, you can consider in 20th. But please ensure you are doing your GSTR 2A to be reconciliations to avoid any disputes with the department. So the disclosures as such, I will not get into the capital goods inputs bifurcation. The major activity here which we need to verify is that your inward supplies, which is liable under reverse charge, how do we verify and pay these taxes? And as chartered accountants, what more can we do? So GSTR 2A or 2B has an RCM, if applicable, yes or no column, which can be verified against yes if they have paid all the liabilities. But that is not the complete information. There are certain entities who are not registered, against which we are still liable to pay RCM. So even a scrutiny of the expense side, the books of accounts, is mandated to verify the missed out any liability against RCM. Important to note that interest against RCM will always be on gross basis, because it is to be paid in cash at any point of time. Table 6E, which is your import of goods, you can take from your GSTR-3B. It will auto-populate. Sometimes in the GSTR-2A, 2B, this data is available. Sometimes there is a variance between your ICE gate. So please cross-check with those documents also. This data has been coming from July 2020 onwards, but there has always been certain information mismatch between IceGate and 2B. So please have a look. You can raise your issues in the IceGate portal and GST portal whenever there are certain import of goods which are not reflecting. Other than this, there is no specific mention. The only mention which I would have to do is any spillover transactions, which means the credit of previous year which is claimed in current year, say 2021 credit which is claimed in 21-22. Ideally, you would have disclosed this in part 5, even though those tables were optional. If you have a backend working of your spillover transactions, you will be able to identify that this table 6A consists of certain values which relates to credits accounted in the previous year. Those credits, in my view, has to be disclosed, not in 6B. It should come to 6M. So if you see my tip on the right side, it says includes credit books booked in previous financial year, claimed in the current financial year. How does this help me when I'm doing my GSTR 2B versus my ITC reconciliation in table 8? That considers only table 6B and 6H, which means table 6M is not covered. Therefore, in my reconciliation, the data which is disclosed as ITC not availed or ineligible will be more accurate to that extent. So these spillover transactions of credits can be disclosed in 6M. 6F, of course, is again from your GSTR-3B. You can take it, verify with your books of accounts for any missed out credits. ITC received from ISD also is from table 4A4 of your GSTR-3B. Generally, majority of the online tools have the ability to give consolidated GSTR-1 and 3B and 2A. So this will be very useful to and easy to obtain. Table 6H in relation to reversal and reclaim in different years. Be careful with this disclosure. When you are putting this reversal, have a tracking mechanism for when you are considering it as a reclaim in your returns. Table 6K and 6L, as we already discussed, is in relation to TRAN. So one of the things which I would like to inform on is the time limit which is applicable on import of goods. Import of goods is a bill of entry based input credit. If you read rule 36, the documents based on which you can claim ITC, you have invoice and debit note, and you have bill of entry and customs related documents separately, which means these are separate documents. Then if you go to section 16.4, which is actually the entry which is restricting your credit based on the time limit, which is now extended to 30th November, they have specifically mentioned invoice and debit note. They have not mentioned documents in relation to input tax credit. They have mentioned invoice and debit note, which means they have specifically kept out the bill of entry and the customs related documents. So this is something which can prove to be useful if you have missed out credits in relation to import of goods. The concept also remains very clear that import of goods are something that you are paying clearly as your own from your own pocket. Therefore, having this reconciliation and verification mechanism should not come into picture. And once I have paid tax to the government and it is creditable, that credit should be a vested right and not a accrued right. Now, this concept of vested versus accrued right has been disputed under GST. Maybe that's a discussion for another day. Table 7, we have the ITC reversals, which is rule 37, 39, 42, 43. 7A is your 180-day reversal concept where vendor payments which have not been done must be disclosed here. Of course, upon repayment, it can be reclaimed. But this is something which we see that majority of our taxpayers are not maintaining the details of, or even if maintaining, are not providing us these details. So how, as chartered accountants, we need to safeguard ourselves is we need to ensure that any such limitations to our activities must be listed down in a single document, and we take a mail confirmation from them. Earlier, of course, this could be a part of our Part B certification, but now, as it's not a mandated document, to ensure you are clear on what you have done, what has not been provided by the taxpayers, having a mail confirmation and documenting it clearly will help a long way. 7B, IST ITC reversal. So this is the biggest difference in relation to cross charge. When you do a cross charge instead of an ISD, you cannot transfer the ineligible credits. So that is something where there's a difference between ISD and cross charge. Government also is expected to come out with a circular on relation to ISD being mandatory and not optional. So that is something which everyone may need to think about. 7C in relation to input and input services only, which is your Rule 42 computation, which is different from Rule 43, and ensure your annual reversal based on actual figures. 7E, your Section 17(5) credits. These details ideally should have been disclosed in your table 4. Now it is now for table 4B1 of your GSTR 3B. Earlier it is 4D1. So the change in the GST forms also was and with an intention to benefit the government to enable them to transfer the correct taxes to the states. So they have a huge accumulation and they are unclear as to who we need to pay. So this disclosure in table 4B1 is going to serve that purpose. 7F and 7G is in relation to reversal of trunk credits. Generally, this is based on your departmental audits. Coming to table 8, which is actually a hugely contested table, wherein a lot of taxpayers are having difficulty in digesting the values which are being disclosed here. So let me be first and foremost very clear. The values which are taken in table 8A will be as on 1st November 2022, which means the values in 2A as on say today may not match with the values as on 1st November because vendors may have filed certain returns in relation to past periods. So this is something which is first and foremost going to have a difference between the data that you download from the GSTR 2A directly and in the GSTR 9. Secondly, the other information is certain place of supply related mismatches also do not come in this GSTR 2A, although it may appear in your downloaded GSTR 2A from the portal. So this is the first thing which I would like to inform on. The next thing is ITC as per the totaling table 6B and 6H. So this is what I was trying to mention is that the ITC as per GSTR 3B, which you disclosed in the above tables, will be taken as a total of 6B and 6H, and they do not consider 6M, which is after 6H. So this is where the values, say the liability, the credit was disclosed by the vendor in 2021. He raised the invoice also in 2021. You booked it also in 2021, but you forgot to claim it in 2021. So 2021-22, you have claimed the credit. This could also hold good for good GIT transactions, goods in transit. So to that extent, this disclosure ensures that 6M you are uploading those transitional details and ensure that this 6B is auto-populating correctly. Whatever credits, of course, for this year, which is going to be claimed in the next year, will come in table 8C, and the difference comes in table 8D. Once there is a difference in table 8D, let us assume a scenario where 8A is higher than the total of B and C. Then that means there is credits lying in the GSTR 2A, which you have not claimed in your returns. So that means it is available but not availed, or it is availed but ineligible. The total of 8E and 8F must match table 8D. So assume a scenario which is in the opposite. Table 8D is negative. That means you have claimed credit which is not there in GSTR 2A. This is something which will be like a reminder for the department, wherein they will first and foremost verify whether you are claiming these credits correctly, whether you are claiming credits which are not disclosed in GSTR 2A by your vendors. For the period April to December, of course, there was an option for an ad hoc credit of your 5%. But that is something which we'll have to verify on an invoice level, whether you have correctly taken the credits on a monthly basis. So this reconciliation of your credits based on Rule 36(4) and Section 16(2) AA will have to be done in a little more detailed manner this time around, and ensure that whatever credits were not claimed for financial year 21-22 either can be claimed now in this by this November returns, or we have to then pass it as an expense in the books of accounts. Another very interesting thing is table 8C does not match to part 5 table 13. So here the values which are disclosed, first and foremost is they have themselves given the information that imports and inward supplies under RCM will need not be disclosed in 8C, but certain credits of the present year which you are claiming in the next year can be disclosed in table 13. Another very important thing is the goods in transit, wherein the vendor has raised the invoice as on say 30th of March. He has uploaded in his returns as on 30th March, but you received the goods and the invoice only on 5th of April. Therefore, in your books of accounts, you have accounted in the books as 5th April 2022, which is a 22-23 transaction. So to that extent, it is not a part 5 transaction of previous year, but it does affect your this table 8A, 8C reconciliation, wherein it will come in the 21-22 8A. Therefore, to that extent, in 8C, consider that value, but do not consider it in part 5, table 13, the goods in transit. Next, we come to the import of goods. So here, like I mentioned earlier, in my personal view, I feel that import of goods does not have a time limit. And therefore, I will disclose this IGST on import of goods simply based on what I'm disclosing in 3B. So if my 3B is showing 50 lakhs, I will show in G and H as 50 lakhs, and my difference will always be nil. This reason, the reason why I say this is if this values as per the IceGate portal says 65 lakhs, but you have claimed only 50 lakhs, it is as though I am indicating that that 15 lakhs I have not claimed. So to that extent, again, I feel they should have given an option. And similarly, similar to the 8C, which is transitional, the spillover transactions, they have not given a similar details for import of goods. So again, here I feel this is an anomaly by the department, but from day one, this has not been changed. But there has been a press release which said that the value, which is your 8K, which is mentioning ITC to be lapsed in current financial year, should not be read in the manner where it will affect your electronic credit ledger. They have very clearly said that this will not reverse your credit. So this is a welcome information for us. And in my view, because of all these reasons, there could be a variance from the actual data to what you are disclosing in this table 8. So therefore, this credit need not be lapsed at any point in time, irrespective of what is disclosed in table 8K. Next, we are coming to table 9, which is your tax payable versus paid. This here is information on the auto-populated data, which will come based on what you have filled. But the tax payable column remains editable. Tax paid, of course, you cannot edit. So first and foremost, we suggest to consider your table 5N values, which includes your additional liability as per your books of accounts, and any additional liability from your table 7, which is probably your ITC reversals, also needs to be added in your tax payable columns. This will not auto-populate, so you would have to edit and add it. Please ensure that. Another important thing is also your negative ITC, which may arise. I will come to that in the upcoming slide. Additional interest also can be added based on whatever additional liability that you have computed. Please note the interest computation under 51 and 53 are now applicable retrospectively from July 2017, and the rules have been changed to that extent. Please go through the interest computation. The Finance Act has made a change in relation to this. Reasons for difference between tax payable and tax paid. So here, one of the major concepts which is being followed is to ensure it is zero. In my view, there is no requirement to ensure it is zero. The more important requirement is to ensure that you have reasons for all the variances that will be disclosed in tax payable versus tax paid. So to this extent, also, I think there was some communication from the department saying that this variance can arise. So this could always arise due to your spillover transactions. So this is another very important reason why I am specifying and harshing on the fact that we need to ensure spillover transaction details for the past year and for the current year must be maintained clearly. Whatever liability is being paid through GSTR-9, please pay through DRC-03. Ability to pay through credit, in my view, again is there, which we will come to in the upcoming slides. So previous year's liability disclosed in 3B which is considered in the tax paid, will be a possible variance. Expect excess paid taxes in current year, which is adjusted in the next year, also could be a reasons for variance. So please, this is just a indicative list. This is not the exhaustive list. So it depends on the situation. Please keep an eye out for that and have your reasons clear. So this is part 5. I think someone had in the chat in relation to the transitional transactions. So FY 21-22 transactions, which you have considered in financial year 22-23. So if you see on the right side, I have given some kind of a check base as to how to fill this table. So when do we fill in part 5? Whether it is booked in the current financial year, it has to be yes. Whether considered in GSTR-3B in this financial year, that is 21-22, the answer is no. Whether considered the next GSTR-3B within time limits, very important, the answer is yes. Then it comes to my part 5. If any of these answers are different, it may not come into my part 5. Table 12 and 13, although it is optional in my view here, because you anyway will be maintaining this information, you may disclose it. It will be useful for your verification in the upcoming years. In table 14, which is your difference of tax paid on account of declaration of 10 and 11 above only, not 12, even though 12 is a possible liability, they are mentioning 10 and 11 only. If it is positive, only consider in table 14, which means if there is a liability, then only consider in table 14, because it asks for payable and paid details. Like I mentioned, 8C and this table 13, which is here, would not match on account of these reasons. So another important tip here is any amendments which are just done in GSTR-1, say B2C to B2B amendment, or where your B2CS has been changed upwards or downwards within the tax period. So all these things need not be coming in this part 5. Table 15 and 16, these are optional tables. I will not consider them now. Next, we have tables 17 and 18. Table 17 mandatory, 18 not mandatory. The additional column, which is rate of tax, has been included from the last year. Now here is where we need to ensure the details clearly. 4-digit HSN has to be disclosed up to 5 crore B2B supplies only. Okay, sorry, I think I had mentioned it is for B2C supplies also earlier. This is only B2B supplies. Please pardon me here. Next is 6-digit HSN has to be used for more than 5 crores transactions. This is for all the transactions. So in GSTR-1, from August 22 onwards, 6-digit HSNs also have been provided as a requirement. And in the rate values, which are mentioned, rate of tax, has also been included in GSTR-1 HSN tab from October 2020 itself, which means for the financial year 21-22, it was continuously required. I can consolidate my HSN values as per GSTR-1, but I need to, of course, reconcile with my books of accounts whether the entire GSTR-1 is my books of accounts values. Check mechanism, of course, 17 and table 5N. For table 18, if you would like to disclose, as it's an optional table, you would have to disclose only those HSNs which account for more than 10% of the total expenses, which can be disclosed. Of course, that is optional, need not be disclosed for this financial year. In my view, for 22-23, this table 18 may be made mandatory. Coming to the late fees column, which is there after the entire form. This is for late fees for this annual return itself. It is not GSTR-1 or 3B. The late fees is rupees 200 per day, subject to a maximum of 0.5% of the turnover of this GSTN. So please be careful. Do not delay your annual returns without reason. One more important thing is section 44 includes reconciliation statement, which is your GSTR-9C. What it says is they have to file the annual returns along with a reconciliation statement. So this may mean to interpret that 9 and 9C are a single form. So if either one are delayed, the late fees can be said to be applicable. But of course, in my view, this is again disputable. If we have filed 9 within time limit, but 9C is delayed, this late fee can again be questioned. But that we'll have to wait and see how the department we use the same. Whatever late fees in relation to 1 and 3B which have been paid in the past, or 1 ideally as it is not paid but payable, that also can be considered in your table 9 of GSTR-9, where your tax payable and tax paid details can come. This declaration I have copy pasted here, which gives the essence and the importance of the data that is being filled. And this is something that the taxpayer must be very clear about before he signs the form. So with this, we have come to the close of the clause-wise analysis. I will take up some of the questions. So if any refund sanction related to previous year 21-22 in 22-23, then will any detail show in table in GSTR-9? Yes, you can show them in your table, I think 15, which we just went through. Yeah, you can show them in table 15, but it should be the refunds which have been claimed in that financial year. So relating to 21-22, if you filed the refund in 22-23, you will have to show it in GSTR-9 of 22-23. Please note, this table is optional. In table 4 is current year meaning 22-23 or previous year 21-22. So in my view, table 4 would mean 21-22, which is your current year. For this 21-22, what the financial year which has just passed, you are filing the annual return in relation to that year. 22-23 is still underway, and therefore you cannot file the annual return for 22-23. Is ITC to be paid under RCM on inward supplies from unregistered? What if not paid as RCM till date for financial year 21-22? So this is a very detailed question. So in my view, first and foremost, RCM liability, if it is there, would always remain. There is no question as such. So to that extent, you would have to pay the RCM. The next question is whether you will be eligible for the credit. So here, if you see, there are two things which you would need to interpret. One is section 31, where it is giving the requirement of raising a self-invoice against RCM against URD vendors. And it is giving and in your ITC conditions, it will give the credit which has to be claimed, where they also mention invoice is same as, self-invoice is same as invoice. So to this extent, my credit is linked to self-invoice, but my section 31 says that I need to raise a self-invoice. The missing link here is your time of supply. Time of supply just tells when it is liable. It does not say that when it is liable, you need to raise a self-invoice. So to this extent, we can always say that because there's a delay in raising self-invoice and paying the taxes, I will pay the interest to that extent. But ITC, I will claim based on the date of my self-invoice. So I will raise the self-invoice today for financial year 2021. And to that extent, I will pay the taxes now. Account that liability also in this present month 22-23, and I will claim the credit. But of course, interest will be payable from the time it is liable as per your time of supply. So this is, of course, a very complicated understanding of the law, and of course, highly disputable by the department. So it's only based on the risk appetite of the taxpayer that this decision can be taken. Next is, if GSTR-9 is filed before filing October 22 3B, can ITC of financial year 21-22 be claimed in October 22 3B? The answer is no. The time limit mentioned in 16.4 says earlier of filing of your GSTR-9 or your GSTR the 30th November. So if you're filing before the October return date, then whatever credit was missed out would remain as missed out. Yes, there is no option to claim the credit in 9 ITC. In table 8A, ITC will be disclosed as per 1/12/2022. Yes, this change may arrive. Of course, there is no clear information on this. Earlier, it was considered as 1st October, considering the due dates which will come up to 31st October. So now, considering this, ideally, I think this should shift to 1st December. But for those persons who are filing the what can I say, the quarterly returns, there may be some differences here. So which period they may take is disputed, but in my view, yes, it should be 1st December and not 1st November. That change has to be done by the department. So to this extent, like you mentioned, will this be sufficient enough time to file the GSTR-9 is the next question, because we cannot consider table 8A until then. But of course, we can keep all the other information ready to ensure we do not delay the filing of the returns. When we are claiming ITC based on GSTR-2B, is it mandatory or compulsory to reconcile 2A for ITC? So in my view, as per the department, you are mandatory to reconcile from 2017 onwards. Of course, there was no law, but they still ask the same thing. But from the law perspective, Rule 36(4) was implemented from October 2019. So from that perspective, on a conservative basis, without having a defiance of the law, yes, you have to do from October 2019 onwards. There were ad hoc credits, 20, 10, 5%, which was allowed. From January 22 onwards, they introduced Section 16(2)AA, wherein they expected you to match it as per the law. And therefore, from then onwards, as per me, it is mandated. GSTR-2B also is mandated from Jan onwards. April onwards, of course, that became clearly mandatory with all the facilities which were provided. So in my view, yes, reconciliation is mandated to avoid any disputes with the department. If you are a risk-taking entity, you have taken the credits correctly, you have all the proof of the credit, you have made the payments, and you have the valid tax invoices and proof of receipt of goods and services, then in my view, that is something that you may have to fight and litigate, but you would succeed at the end of the day. But it would probably go up to High Court or Supreme Court. So I think I've covered all the questions. I will get back to the topic on hand. So we have the disclosure of spillover transactions. Table 8C versus 13. I've again given the information, but it's already discussed. I will not spend time on that. Table 8D and 8K also has been discussed while we were discussing the tables itself. Negative ITC I will speak on. Table 5, taxable value, additional liabilities. All of the others we will be discussing now. So this is a simple representation of how we need to disclose while filing 99Cs. So say you have booked the entry. Now, when we say booked this entry, I mean my outward supplies. I have booked it in my books in 21-22, paid the liability in 22-23. In GSTR-9, I would disclose in table 10. In GSTR-9C, there is no specific disclosure because the value which is considered in your AFS is table 4, 5, 10, minus 11 for the total value. So this is why I said do not do any internal individual linking from 9 to 9C, because there are certain requirements of 9 which will come in the 9C, which is a downloaded value which will be calculated by the system itself. Next is your debit note scenarios. So here, same concept, debit original invoice is dated 21-22, debit note is dated 21-22. But the debit note is reported and paid in GSTR-3B of 22-23. In this time, do table 10, 9C, again, no information. The comments will remain same as above. Let's take a scenario where debit note is raised in 22-23. The original invoice is dated in the previous year. This is what I meant in the table 4, credit note and debit note which is issued in respect to the above. So this is the concept which I was discussing. And this is where there could be an alternative which is possible. In my view, it is a transaction of 22-23. But if you are disclosing in table 9 in 21-22 itself, you can disclose in 4J. If you are considering it as a transaction of the next year, then it goes to table 10. And in your table 5O, these reasons for differences can be mentioned. The alternative part is to not disclose in GSTR-9 at all. Consider it as a transaction of 22-23 and disclose only over there. In your 9C, if you see, because it is not considered in the books of accounts, it would not appear even in the 9C as a reconciliation item. Only if you do disclose in 22-23, 21-22, sorry, it becomes a reasons for difference. Next is in relation to credit note, similar scenarios, but one major difference is your time limit for raising the credit note. There has been a lot of discussion on this, whether 30th November can be the last date of the credit note or should it be disclosed in the returns by 30th. So erring on the side of conservatism, saying to ensure that my credit notes later on are not disputed, I feel 31st October can be read as the due date to raise the credit note. Disclose in your GSTR-1. Hopefully it was disclosed by yesterday, and in your 3B reduce your liability to that extent. Here again, we have both these scenarios where original invoice and the credit note is in the same period, but it's disclosed in the next period. Then it comes to table 11 directly. If again it is a credit original invoice in the previous period and the credit note raised in the next period, then again you have the same alternates based on similar to the debit note. This is 4I and table 11 because the reduction in your liability. Alternate option, of course, is to consider in 22-23 returns 99C direct. Next, we have advanced received scenarios. So advance has been received in 21-22, and it has also been, tax has been paid in GSTR 3B in 21-22. So to this extent, the invoices which are issued and paid against the advance are done in 22-23, and that has been adjusted in 22-23. So here is a clear example where the advances remain open, which means it has not been set off against any invoice as on 31st March. Then only they come into the advanced scenarios, and then you would have to disclose in 4F. In 9C, this comes under table 5C. Verify the advanced ledgers in your books of accounts, as these will not form part of the turnover in the audited financial statements. Next, we come to an advance which is received, tax paid, and the invoices which are issued against these advances all in the same year. Only thing, these invoices which are issued and paid are adjusted in the GSTR 3B in 22-23. So in GSTR 9, you have again two options here, because it is already booked in the books of accounts in 21-22, and I have previously mentioned, consider table 4 as per books of accounts. You can consider them in table 4A, 4B directly, B2B or B2C, and table 11. So to this extent, this table 11 disclosure could lead to a double tax payment in 21-22 if there is no adjustment in GSTR 3B. So to this extent, what we are mentioning is consider both of them, and in the GSTR 9, you consider in table 11 also. This would come as a variance in tax paid versus tax payable, because that is how it is representing in 21 and 22. In GSTR 9C, in your table 10, this again becomes a reason for variance in the tax paid reconciliation of taxes table. So advances which are received and refunded back to customers in financial year 21-22 itself. So this is between table 4F and 4L. No disclosure also is acceptable, because these both are compensating disclosures. Next, we have the disclosure on account of spillover transaction in relation to ITC, which is pertaining to 2021, which is claimed in the 3B of 21-22. So here, the requirement to disclose in GSTR table 9 is table 6B or 6M. So in my view, these are the two options which are available. In my view, table 6M is the better option. In GSTR 9C, it will come in table 12B, and table 14 is the reasons for that. Table 14 is the details which is remaining optional. 12B is where the details can be disclosed for the time being. So the only difference between 6B and 6M is the disclosure variance that may arise in table 8 between your 2A reconciliation. So ideally suggest to disclose in table 6M such entries. Next, we have inputs pertaining to financial 2021, which is reversed in the GSTR 3B of 21-22. Here you can also take the similar thing for 21-22 and 22-23. Here, let us assume that the ITC was availed in 2021 and reversed in books in 2021, but reversed in 3B in 21-22. So to this extent, in table 7H, I will make the reversal. And in GSTR-9C, again, it will go to my table 12. So this is that reversal which can be considered. It would have already been part of table 12 of the previous financial year 2021 GSTR-9, which is your ITC reversal of the next financial year. But that was only a disclosure requirement, not having a tax impact. So therefore, because this was reversed in 3B of 21-22, and we need to file table 6 and 7 as per GSTR 3B and not as per books. Here again, we would have to disclose in GSTR 9 in table 7H. So this is the major difference between outward and inward. There would be a compensating difference in table 20, for which you can provide a reason for difference. So one of the biggest learnings in the past for me in relation to disclosures was any variances which arise in table 9, in GSTR 9 or 9C. If I have a reason for the same, I first verify whether it can be considered in the above table. If it cannot be, I just give a reason for difference. And maintaining that difference is not a major issue presently in my view. Next scenario is where in ITC is availed in 2021, but only in the next year it is reversed in books 21-22 and it is also reversed in the GSTR 3B. So as on 2021, because this credit was not supposed to be reversed, it was not known. So to this extent, in my view, it is not a transaction of the previous year at all. And therefore, there is an option not to disclose in GSTR 9 of that period. In my GSTR 9 of 21-22, in my view, table 7H itself, it can be disclosed because of the simple fact that the liability has to be considered because you have reversed in your books of accounts. In 21-22, it will, considering the impact in 7H, it would not result in a difference between ITC as per 7J in GSTR 9 and table 13 of GSTR 9C. The reason why I'm saying this is in your GSTR 3B also, this would have been considered as a reversal. But in your books of accounts, it would not be considered. So to this extent, between 7J and table 13, there may not be a variance. But if it had been a part of your table 12 of GSTR 9 of financial year 2021, there could be some reconciliation impact which has to be disclosed. But to this extent, what I would like to simply convey is whatever you are disclosing in GSTR 9 in table 6 and 7, consider it as per GSTR 3B. In your 9C, you would have the values as per the books of accounts, which is then compared to values as per 7J, which is your GSTR 3B values. Whatever variances that arise, which is the basic difference between books and your 3B, that would have to be disclosed as your reasons for difference. Next, we have 8C versus 13. This was already covered. I will not get into it additionally. Next, we have table 8D and 8K analysis. This also was discussed. The concept being that these disclosures do not have a direct impact on your credit ledger. But one of the most important things as chartered accountants, in my view, is that 8D difference, wherever it is positive, in our minds, we should verify whether there is any missed out credit so that we can see whether we can benefit the client going forward, how if they have missed out any credits. If it is negative, then we'll have to verify why those vendors are not filing their returns, what is the issue. We can give certain process improvement suggestions, that is creating a very robust onboarding, vendor onboarding process, having a vendor categorization, which is ABC categorization, wherein A category is very well compliant, B category is organized but not that compliant, and C category belongs to the unorganized and the non-compliant. So to this extent, your payment terms can differ for the ABC category, which will also save your cash flows and ensure your compliances. So these are things which are over and above this 99C, I understand, but these are process improvements we can always suggest to our clients. The next point which is there is on the negative ITC. So this is, if you see the first screenshot, it is from the GSTR-3B. Of course, this is the old GSTR-3B, not the new GSTR-3B. But the concept would remain the same, which is, if you see in the table 4C, net ITC, which is available, we have a negative value, which means when we are filing that month's return, we did not have sufficient credit to pay that liability, and that liability now has to be paid in cash. This value need not only be paid in cash. To this extent, if there's a balance ITC also which is available, it can be utilized. But this is considered as a liability for the purpose of this table 9. So in the paid through cash or paid through ITC, this 88,000 would already be included as a paid value. And therefore, to ensure my GSTR-9 table 9 matches between payable and paid, to this extent, I will add this value in my tax payable column as it is editable. To that extent, I will also disclose this in my table 7 of my GSTR-9. And additionally, because this table 9 is linked to my table 9 of GSTR-9C, your reconciliation, to that extent, this tax paid on account of negative ITC can be considered under the others in table 9 of 9C. So this is this is another additional information which will help clear reconciliation in your GSTR 9 and 9C. The next we come to additional liability which could arise based on two reasons. First and foremost, short payment of taxes, either outward supplies or RCM, which you would have to add to the table 4 of GSTR 9, and also to consider it in tax payable in table 9 of GSTR 9 and discharge through DRC 03. Next liability is through the excess claim of ITC, add to table 7 and table 9, and then discharge through ITC. Any interest which arises on delayed filing of returns or delayed payment of taxes should also be considered and can be added in table 9. Late fees in relation to 3B would ideally automatically compute, so there is no requirement there. But late fees in relation to GSTR-1, ideally we are seeing huge delays in April and May 2021, when there was our last COVID period in India, where there was certain delays which had happened for filing of returns, but there was not sufficient waiver of late fees from the department. So late fees also still continue. So to that extent, please verify your late fees for those initial periods and any other periods that has been delayed. GSTR-1 does not auto-populate. It has to be manually computed and paid. So the other point, which is in relation to ITC, which is used through DRC 03, which is my annual returns. First and foremost, the portal does allow me to utilize ITC even when I choose the option annual returns. But in the instructions, in the CGST rules part B, they have mentioned that the payment must be made through DRC 03 only. This was there from the beginning of when the form was created, but the form has undergone changes. When I started this PPT, I mentioned that GSTR-9 was supposed to be a consolidation of GSTR-1 and 3B filed only. There was not any additional liabilities which were allowed in GSTR-9 in the beginning. After that, they brought the changes in para 4 of the GSTR-9, thereby allowing additional liability payment through this GSTR-9. GSTR-9 remains a self-assessed form. It is not a form which is out of the assessment of the taxpayer. Therefore, why will I not be allowed to utilize the credits against this liability? I am assessing and I am paying the credit. I have claimed the credit in the past. It is just a ITC balance which I'm utilizing for payment of tax. So keeping this in mind, section 49(4) and rule 86(2) in mind, and your section 73(5), because this is a return which is filed before prior to any notice or statement of demand. In my view, utilizing of ITC for any liability is 100% allowed, and also the portal is on our side. But on two counts, please be careful. One thing, department may dispute this, and if you're conservative or a risk averse, please avoid. Second thing, in relation to your RCM, you would have to pay in cash only. There is no option to utilize the ITC. Interest computation, be very clear. The concept remains that if it is a liability for the period which has been considered in the period, but only the return has been delayed, only then the concept of net liability would arise. That means if a liability, say of March 22, was disclosed in March 22 GSTR 3B, but instead of filing by 20th April, you filed on 5th May. For that period, you would have to pay on net liability basis, which means only on the cash portion. But if you have paid a March liability in, say, June 22 return, then that liability will not have the benefit of net liability. Whatever the liability is, irrespective of its RCM or normal outward supply, it has to be paid as gross interest, and it will be 18%. This is for outward supplies. Inward supplies interest computation also has some clarity now, wherein they have said against that ITC which is claimed, it must be first of all ITC wrongly claimed and utilized. So please be very clear, it should be wrongly availed and utilized, not or. That was the issue earlier. So which means that if I have availed but not utilized that credit, I do not need to pay interest. Another clarity which is there is it is 18% and not 24%. So in the past, if you have paid interests on the concept where it is on availed and it is at 24%, you would be able to apply for a refund for that excess payment of interest also. So this is some additional information in relation to interest. So some of the basic FAQs which is generally asked, first and foremost is that outward supplies 3B and 1, should I match it, and how do I file my GSTR-9? In our view, irrespective of what you have shown in 3B and 1, consider the correct values now in GSTR-9. Next question is, my vendors' invoices are not reflecting in 2A till September. Of course, now it will be till October. What can be done? In this situation, there are two views. Again, this is based on the risk appetite of the taxpayer. So up to, I will answer in two levels. Up to December 2021, in my view, we can maintain an aggressive stance. But after January 22 onwards, in my view, we would have to move to the conservative stance because of the earlier mentioned fact that Section 16 to AA came into prospective effect from 1st Jan 2022. So aggressive view is that up to December 21, if I'm satisfying all the conditions of Section 16, and by all I mean all of them, other than the fact that I need to verify whether my vendor has filed his tax returns. Other than that, as per me, we can claim the ITC, and to ensure we are indemnified against any possible demand in the future, because the vendor is not filed, you can ask him to give a declaration. Conservative view, of course, do not claim ITC. Option, of course, remains to recover from the vendor or pass it as an expense in your books of accounts. Import related credit, in my view, as discussed, time limit does not apply. And one of the major questions which has been recurring in many taxpayers' mind is, should we involve the professionals as the mandatory audit is removed? So in my view, where the entities have a very strong internal control process, they have an internal team also of chartered accountants, and they are doing proper reconciliations on a monthly basis. They do not need a additional professional for filing 9(9)(c). They may need a professional to review their internal control processes, whether their tax positions, tax masters have been kept correctly, but otherwise they may not really require a professional for filing these returns. But those who do not have these kind of robust procedures, a back-end team to assist them, and do not have these clear reconciliations kept, then of course I feel the professional like a chartered accountant would need to be involved. So what can we as professionals do for in relation to 9(9)(c)? First and foremost, the interpretation of the law in certain situations has been disputed in GST. Many places we see divergent views. advanced rulings itself are going in two ways. Even high courts in the recent past have gone two ways. So there is a little bit of ambiguity in the law. So please be vigilant in that regard. Any complications in relation to the law, please keep yourself updated. If unclear, take an opinion from any expert in this field. Next, insist on getting everything in writing or record the oral transactions through minutes of meeting through your emails. So what is the common practice now is that people are transferring data through WhatsApp, but you do not have any proof of all this in the future. This may be very tough to document. Please use online Gmail or Outlook or any formal process and document all your informations. Assessee may represent wherever they feel it is unfair to them. Many representations, of course, have gone to the department. Some have been considered also. Doing your representations through associations will be more useful. This is something that we can tell our clients. Safeguarding our client by way of suo motu declaration. So this is a method of compliance which was used in the pre-GST regime. The concept of initial disclosure letter, which has all the information in relation to internal verifications and also my internal tax positions which have been taken and details of my business in a brief manner. What happens is once I give this initial disclosure letter to the department, they cannot say that I have hidden information from them or I am not a bona fide assessee. So first and foremost, in under section 73, the notices should come. If notices come under section 74, which is under the fraud, willful misstatement or withholding of information, we can forthwith say that the initial disclosure letter was already provided and inform that this notice is invalid. So that is one of the best ways. Of course, the biggest benefit is that there is a time period of 3 years for the section 73 and section 74 has 5 years time limit and the penalties are higher in section 74 on account of being fraud, willful misstatement. So all that can be avoided by this one single disclosure. If you are doing this, please do not go visit and inform and do all these kind of processes. To send it through registered post acknowledgement due, keep that documentation in your departmental correspondence file. If you are at any point of time, you are the taxpayer, your clients are being forced to pay in cash, pay under protest, there are remedies which are available for this. Of course, you have seen many circulars and case laws also in the recent past, which are in favor of the assessee. In case of high-handedness by the department or any unreasonable behavior, please escalate in writing first, then further escalate it with CC to the concerned officer, then escalate to your commissioner vigilance if the money is demanded incorrectly. And then step 4 would always be to meet the commissioner directly. Of course, this may change on the situation on hand and what it requires, but this is generally what we feel is the possible route. So I have completed the session as of now. I think there was some question. Yeah. Annual return for e-commerce operator under GSTR under 9B is notified or not for 21-22. So in my view, 9B, I think has been exempted, but I would have to verify whether there is a notification for this. I will have to get back to you on this, So if you have any questions, and Vinod specifically, if you can give me a, yeah, I think Pramod has would like to answer this question has been said. Pramod sir, any views?
I'm there. Is there anything on your chat box personally?
No, I think I've answered all the questions. I think Vinod's question I would have to verify once and get back to him on the e-commerce operator 9B. Otherwise, I think I have answered all the questions in the chat and the question and answer.
Yeah.
So I have given my email ID on the, it should be displaying on your screen. So if you have any further queries, you can go through. And Pramod sir, I think this document will be shared with them in PDF format.
Yeah, we'll be uploading this in the website.
Great. Thank you, sir.
Yeah.
So yes, if there are no further queries, then
Should we
can-
wait for 5 minutes if they want to
Sure,
post
sure.
any questions?
Sure, no issues. We have time, so we can.
Yeah, we have time. I think there's one on chat box. If the reversal of
So-
ITC for financial year 21-22 hasn't been shown in GSTR 3B till October 22 GSTR 3B, then whether it can be shown in GSTR 9. What are the implications?
Okay, so yes, so this is a liability, first of all. So if you have not shown in the October GSTR 3B, you can consider in table 7 and disclose the liability. Also consider that as your tax payable because you would not have paid the taxes on it. So tax payable, add that liability and discharge to the DRC 03. If you have ITC balance, then yes, utilize the ITC balance to pay that. But that utilization through DRC 03 may be questioned. So if you are risk averse, pay through cash. I think there's one more in the other chat box.
Whether the input tax credit is reflected in GSTR 2B, then it should be reflecting in GSTR 2A. Is there any chances that it would not have been reflected in GSTR 2A?
In my view, this there is a situation where ITC which is not eligible may not come in your GSTR 2A in your table 8A. So your table 8A, if you see, there are certain differences with table 8A 2A values which will come in GSTR 9 to the 2A which you will download from the portal. So in 2A, sometimes whether it is return is filed or not, yes or no, also will come in the GSTR 2A. But in GSTR 9 2A values that may not reflect, where that place of supply variance is there, it will automatically not reflect in 2A, but it will come in the 2A of GSTR 9, but it will reflect in your downloaded GSTR 2A. And like we mentioned, that time limit which they will put for the GSTR 9 will be applicable for the 9 value, so it will be frozen. But the GSTR 2A upon download will keep on changing. So that will remain.
Please tell us the difference between GSTR 2A and 2B.
So GSTR 2A is a dynamic report, which means as and when the vendor is filing his returns, he will the values will get updated in that month's GSTR 2A. So if I'm filing my returns, say GSTR 1 for the month of August today, the August due date was 11th of September, 11/9. But I am filing it on 11/11, August GSTR 1. In GSTR 2A, for the month of August, in 12th, it will go and reflect in August month itself in GSTR 2A. But in GSTR 2B, it will not reflect in August month. August month will show nil value. And this will now reflect in your November, the October month data, which will come for your November month. So it is GSTR 2B is a static report. It will take the data as on your due date. If you go beyond your due date, it will go into the next month. Whenever you're filing the return, it will go into that month. So that is the biggest difference between 2A and 2B. 2B also discloses your ITC, which is not eligible based on place of supply. So if my supplier and the place of supply is in the same state, but my recipient is in another state, then that will automatically go as ITC, which is not eligible. And any credits where your date of invoice is before the time limits which are mentioned, say as of now, you are putting 2021 in your date. So you say you put May 2020 as your invoice date while filing GSTR 1. It will consider that as an ineligible credit for your customer. It will automatically go and set as ITC not eligible. So place of supply generally, which is applicable for your restaurant business, where your place of supply and the supplier are in the same state, but you may have come in from another state and stayed in that hotel. You give, say, Karnataka GSTN for a Tamil Nadu hotel, that credit will automatically go and sit in your ITC not eligible. Such bifurcations are not clearly available in GSTR 2A, but it is there in 2B. In my view, 2B is a very good tool to be used for your reconciliation.
Is HSN outward supply table is net of credit/debit note?
Yes, it is net of credit and debit notes. So ideally, in my view, match it to table 5N, which also is the net of credit and debit notes.
If any month when credit note tax greater than output liability, in this situation, what can we do in GSTR 3B?
Yeah, so this is a very good question. The department had in their earlier iterations of the portal said that they will change the portal which will allow the negative values to be shown in GSTR 3B. Of course, you can adjust the liability, the negative liability against future liability only, but they were allowing you to disclose it in GSTR 3B in theory, which means they were supposed to do it, but they never did it. So to this extent, in my view, this should be allowed. You should be able to do it even after time limit if you have already disclosed in your GSTR 1. So to the extent that you are not having any liabilities in the future and only a credit note, then whether you have an option of going for a refund may need to be studied.
We have one more question.
Yeah.
Can we claim the input service where the services are rendered in Karnataka, but the services are raised for the head office in some other state, Delhi or etc.? Can the other HO, excuse me, can the HO claim the input tax credit if the invoice raised by the service provider as IGST service?
So in my view here, even for services, they have allowed the bill to ship to concept in the law itself. So based on the invoice, the bill to party is eligible for the credit, and yes, he should be eligible to claim the credit as IGST. But if that credit is relating to another location, then again you would have to cross-charge that credit. In this situation, if it is a third-party invoice, then there is a requirement of IST registration and transferring the credit directly to that location.
And one question not relevant to the session has been posted. You can choose to take it. Whether export can be made under LUT in 1 month and with the payment of IGST in another month in the same financial year to avoid the refund process.
100% it can be done. But please plan your refunds carefully. Can we book expenditure in HO related to expense related to branch? You can book the expenses, but you may not be able to claim the credit. So your difficulty would arise on the credit portion. So in the location where the GSTN has been mentioned, please consider the credit in that location. So I think the leading question to this which arises is, now that there is ITC which is accumulating in the branch, how do I transfer it to my HO? So here, as per me, the concept of transfer to HO is not right. That would be a tax evasion and not a tax planning. So to the extent that you actually have certain services which are being rendered by branch to the HO in relation to of any admin activities or any accounting services or anything in that line, then maybe you may be able to transfer some of the credit back based on your valuation. Be very careful. Recently, there was a JSW Steel High Court case wherein there was a transfer of credit which was just based on some documentation which was not clear. And then they disallowed, saying that there is no rhyme and reason to this transaction. There was no levy, and therefore the credit was disallowed for the receiving entity. Place of supply in case of dealer's commission voucher. I think you'll have to be a little more clear on your question. Yeah, PPT will be shared in PDF format, I think, by ICA team after the session.
Yes, it will take some time. We'll upload it regularly. There's one more question.
Yeah.
April invoice was charged at a shorter tax rate and debit note has been raised in October month and the amount of short tax has been paid through ITC. Whether interest has to be paid and whether from 20th May to 20th November.
April invoice was charged. Yes, in my view, the liability would arise in relation to interest. Because of the change in the interest computation now, what they are mentioning is that you need to pay the liability of that period should have been shown in that period. Only the delay is allowed in relation to filing of the return. So as it is an April liability disclosed in November, the interest would have to be paid on a gross basis, even though you utilized ITC. This is as per the strict reading of law. In my personal view, the erstwhile concepts which is there in your Aichi Motors, Daiichi Karkarya. So in these taking that guidance, I feel that because I have an ITC balance, I should be considered as a person who has already paid tax to the government and therefore need not be paying the interest. So to this extent, this will be disputable. So again, here your risk appetite comes into question.
There's one more question in your chat box.
Yeah, I'll just go.
If we pay commission to dealer on basis of sales in brand GSTR-9, which he made on our behalf, on it, he prepared a commission tax invoice on GSTR number of HO.
Yes. So then HO will be the one who will be claiming the credit because it's the GSTN is theirs. But if it is the sales in relation to branch and the branch is separate, say a CNF branch, then to that extent, would you have to transfer the credit to the branch? The answer may be yes in that scenario. Why I'm saying maybe is because it depends on the agreement which is there between the commissioner, the commission agent and the whether it's a branch or the HO. So if it is between commission agent and HO only, and it is not with the branch, then as per me, ITC need not be transferred back. It can be retained at the HO level itself because only GST is having a state-based bifurcation, but not the many of the other laws. So others may be PAN-based. So I don't see a requirement to transfer back the credit to the branch. But be clear on who has the agreement and who is signing those agreements.
GST on canteen charges, transportation charges, notice period is leviable or not?
So I think there was a recent circular, which was, I think, 177 or 178. So you can please go through that. These answers are very clear over there. Wherever it's in the nature of liquidated damages, which is in a nature where it is a compensation which is being provided rather than a supply, then the liability does not arise. There is no requirement to pay tax because levy itself would not arise in these scenarios. But let me be very clear. Departmental understanding of this, whether they will follow through, is something which we yet have to see. But because it's a circular and their department is bound by a circular, in my view, they will follow this. But another important change is that be clear in the agreement whether there is any positive service which is being provided against that consideration which is being provided is what you would need to see. If it is only a compensation in nature and it is not intended, then it would fall under this liquidated damages. Otherwise, it's a positive service. Say you and me have gotten into an agreement where you say that as both of us are CAs, you have asked me if you do not practice in Ahmedabad, then I will give you 1 lakh per month. Now that is something which is liable to tax, but these kind of liquidated damages may not be liable to tax.
Again, question related to the previous question, but circular is referred only to blocking of ITC, only discount rendered by creditors, GST levy.
Circular referred. I did not read it as such. In my view, it was the concept of liability or liquidated damages. Give me a moment. I can check in the CBIC portal also.
And in addition to that, whether write-off of sundry creditors, GST payable or not.
So sundry creditors, this is against a liability which I am supposed to pay to the vendors. So in relation to that, if I have claimed any credit and I have not made a payment to him, your rule 37 comes into picture on the basis of 180 days. So if you have not paid the tax, then of course you would not be eligible for that credit. So to that extent, you would have to reverse the ITC and then verify your interest liability. So yes, sundry creditors you would have to verify. Ideally, these kind of adjustments would come as part of your 9C, which you would need to verify. In relation to debtors, there you would have to verify whether you can raise a credit note or not, or if you can collect the taxes from the customer before the end of this period. Circular 178, it is, have it open. Subject is GST applicability on liquidated damages, compensation and penalty arising out of breach of contract or other provisions of law. So this is not in relation to ITC, it's in relation to the liability itself. Are government grants such as startup R&D subsidies GST payable or not? There's a specific mention in the consideration clause in GST law, where it says the government grants which are provided from central government and state government, only those will not be considered as consideration. So anything else which you get would be considered as consideration and tax would have to be paid. So a lot of entities got some kind of subsidies due to COVID, and not mainly from the central government, state government. They would have got from NGOs, etc., which are not CGST. So there probably the liability would have to be verified. I think this objection from department for not maintaining consistency with LUT and payment of GST in case of exports. Is there any notification to take the stand? As per me, there is no notification to take the stand, but there is no restriction also as per the law. So I don't see an issue.
Think should we wind up, Akshay?
Yeah, sure. I'll just respond to that 9B. I may need to see a few notifications. So maybe I will send it to you post the session.
Sure. Thank you.
So I would like to thank ICA again and all the participants for their patience and their time on a weekend. I hope I was able to add some value to your already existing 99C knowledge. Thank you again, and
Yeah.
all the best.
Thank you, Akshay. Thank you for taking up this and enriching us a knowledge kitty on a Saturday evening. Definitely, you did add some value to our knowledge kitty today. Members, I would like to announce there's a 2-day seminar on real estate, which will be held on 2nd and 3rd December. Uh, this will cover various aspects of real estate of all the uh, statutes possible. Kindly take a note of this and register in advance. And also, thank you for taking your time out today and making it convenient to attend today's session. And I see a large number of people, even though on a Saturday evening, have gathered for this session. Yeah, we would like to have this continuous support going forward as well. Thank you, members. Thank you once again, Akshay. On behalf of Bangalore branch of SIRC, I thank you once again.
Thank you. Thank you. Have a good day.
Good night.